JPX Energy Market Weekly Updates. The oil market came under pressure last week. A partial recovery in US dollar put pressure on oil and broader commodity complex, but poorer demand outlook and easing of tightness of European market appears to have been a key catalyst for the downside move. Easing geopolitical tensions between Russia and NATO over Ukraine also helped add the sell-off. Crude prices started the week on a bearish note as mixed messages from China of its COVID policy continued to cause uncertainty. Sentiment was further rocked after the OPEC and IEA said demand growth was slow in 2023. OPEC revised their demand growth forecast for both this year and 2023 down by 100,000 barrels per day. OPEC forecast demand for their crude oil to be 29.3 million barrels per day in 2023, compare output in October of 29.49 million barrels per day. Given the sizable supply cuts from November through until the end of next year, OPEC supply was still lower than demand for OPEC oil over 2023. The IEA lifted its oil demand forecast for this year on an upward revision to Chinese consumption, while 2023 has been reduced by 40,000 barrels per day. Demand will remain lackluster during the first quarter of 2023 and will regain meaningful momentum in the second quarter, going beyond 2019 levels in the process. The IEA also warned a tight distillate supply will remain a drag on oil demand in the month ahead, with high diesel prices feeding to inflation and weigh on its role as a driver for economic growth. Global diesel and gas oil growth is forecast to ease from 1.5 million barrels per day in 2021 to 400,000 barrels per day in 2022 before posting a small decline in 2023 under the weight of persistent high prices, a slowing economy, and despite increased gas to oil switching. On the supply side, the IEA expected the world oil production to increase by just 740,000 barrels per day year-on-year to 100.7 million barrels per day. Non-OPEC Plus output will rise by 1.8 million barrels per day, led by the 1 million barrels per day coming from the United States, and to a lesser extent Brazil's 300,000 barrels per day and Norway's 270,000 barrels per day. If maintained through 2023, the OPEC Plus decision to cut official production targets slows growth outside of Russia to just 340,000 barrels per day. The IEA also expects the Russian oil output to fall 1.4 million barrels per day next year after the EU ban on seaborne export comes into effect for crude next month. But for now, Russia has largely mainlined production levels. Output in the first half of November has shown signs of edging higher, with reports from the country suggesting daily output was 1% higher than last month at 1.48 million tons. With the embargo looming, the shift in Russian oil export has become more urgent. Russia continues diverting cargoes from its core European customer base to Asia and competing with Middle East producers. Russian Urals crude is classified as medium sour crude, with the closest quality matches typically found in the Middle East. Heavier barrels such as Iraqi Basra medium are being sought and blended with lighter grades to create a Urals look-like. This has distorted prices to the upside in favor of Europe than Asia, although Middle East suppliers are set to step up westbound shipments in a broader reset of crude oil flows. The Brent and Dubai cash spread raised to a fresh 5-month high as European refiners scrambled to secure replacement barrels ahead of looming sanctions, while sluggish demand in Asia and increased competition for Russian barrels has weighed on east of Suez markets. The excess supply of crude into Asia has also seen a sharp contraction in Dubai cash market structure, with a prompt first-line and third-line spread valued Wednesday at a fresh 6-month low of $2.4 a barrel, while the one-year curve was hovering around $8 a barrel, the lowest since January. There are signs of weakness on the European market as well. Weeks-long strikes at French refineries and rash refinery maintenance also curbed the call for crude oil in Europe as runs slowed. European refiners have found themselves oversupplied with crude as an expected shortage owing to the looming EU ban on Russian oil has yet to materialize. At the same time, the downward trend of European diesel crack spread continued as rising imports into the region weighed. Diesel arrivals into Europe from Russia, the Middle East, Asia, and the United States are expected to reach 3 million tons so far this month. U.S. commercial crude oil inventories drained 5.4 million barrels in the week to November the 11th as runs ticked up and imports fell, according to the latest EIA data. Because the European market has been the core of the Atlantic Basin market this year, the drop of the United States crude oil stocks didn't bring any relief to the short-term downward pressure. Prompt time spreads of these benchmarks have weakened significantly as the front-month and third-month Brent spread narrowed to around $1 a barrel, while December and January WTI spread flipped into contango. Okay, that's all we have for this week. Welcome back next week.